Ladies and gentlemen, good day and welcome to Shree Cement Limited Q3 FY26 earnings call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Naveen Shahado from ICICI Securities. Thank you and over to you, Mr. Naveen.
On behalf of ICICI Securities. Hello?
Yes, sir, you can go ahead.
Thank you. Good evening, everyone. On behalf of ICICI Securities, I welcome you all to the Q3 FY26 earnings call of Shree Cement Limited. Today, we have with us Mr. Ashok Bhandari, Senior Advisor of Shree Cement, Mr. Subhash Jaju, CFO, Mr. S.S. Khandelwal, Company Secretary, and Mr. K.K. Jain, who is Head Finance and Accounts. So without any further ado, I hand over the call to the management for their opening comments. Over to you, sir.
I had been following the practice of not making an opening statement because it unnecessarily repeats all the numbers which are already in your hands. So to utilize the time...
you, sir. We missed the opening.
Good evening, everybody. This is Ashok Bhandari. As per my past practice, I shall not be making an opening statement as all the numbers are with you in the form of results. We may start the Q&A to use the time more efficiently. Thank you. Hello?
Yes, sir. Should I open for the Q&A?
Yeah.
Yes, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Rahul Gupta from Morgan Stanley. Please go ahead, sir.
Hi, thank you for taking my question. A couple of questions. First, given you are prioritizing absolute earnings, your volumes have lagged the overall industry to some extent. Now, in fact, your operating rates would be more like mid-50 utilizations. Now, how should we think about your capacity expansion plans and target of 80 million ton from the next 2 years perspective? How should we look at your volumes from the next 2 years perspective? That's my first question. Thank you.
Mr. Gupta, thank you for your question. Now, please understand that since October 24, I've been maintaining that we will be concentrating on value over volumes. That was with a purpose. The purpose was very simple. We had a large divergence between our sales price and sales price of competitors like Ultratech. If you will notice, by restraining our volumes, we have narrowed the gap from about 30 rupees a bag to about 15 rupees a bag. Now, naturally, if you want to maintain discipline on pricing and narrow down the gap, you had to take the pain of sacrificing volumes. That is what we did, and I am very happy to report that the December growth, though aided by additional demand, over November, volume-wise, November we sold about 27 million tons. December we sold 33 million, 2.7 million and 3.3 million tons. And January is more or less in line with December 25. We expect the same momentum to continue with a much higher realization, and it should automatically improve our capacity utilization. On the other hand, the capacity utilization will further be augmented by our concentrating more and more on RMC plants, which shall give me a better geographical reach, a more logistical cost optimization, and increase the volumes as well. Now, coming to your second question of our declared capacity of 80 by 29, 29 is still far off. We are still sitting in 26. We shall get back to you in due course.
Got it. So two follow-ups. One, given you have narrowed the gap from 30 rupees to 15 rupees, is it fair to say that you would continue to focus on reducing this further? And my second question is, what would be the absolute revenues of the RMC business, and how much cement your RMC would be using internally? Thank you.
My dear friend, your first question is infectious. You are saying that will you keep on reducing the gap? It is obvious. I'll keep on increasing my profits. So that is one part. The increase in profit mainly in cement is because of top line. The cost is more or less the same for the industry, except in few factors. Point number two, as on date we have 19 RMC plants. We intend to take it to 45 within next 6 to 8 months. Means you can easily assume that by September 26, the number of plants will increase to 45 from 19. We started RMC about 2 years back, and in 3.5 years, we will be achieving 45 plants, whereas leading players in RMC like Ultratech has over last 25 years set up only 100 plants. So we are in track. It is very difficult for me because much depends on how the demand scenario emerges. But certainly all my RMC plants will be using my cement, and it will aid the cement quantity and capacity utilization.
Thank you. Just what would be the revenues from RMC as of now? And what share of how much cement is it?
It's 71 crore for.
One second, I'll ask Mr. KK Jain to give the answer.
It is 71 crore for the quarter.
71 crore.
Right.
For the quarter, we did 71 crore, my friend, on 19 plants.
Got it. And how much captive consumption of cement is going into RMC?
So 45% is the captive consumption for RMC plant for the quarter.
Got it. Thank you. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Pinakin from HSBC. Please go ahead.
Yeah, thank you very much, sir. Sir, what is, in the September quarter, the sales volume was 7.9 million tons. What would be the comparable sales volume in the December quarter?
8.7.
That would imply a roughly 7% decline in blended realizations, which seems to be higher than what the peers have reported. What would be driving this decline in realization, sir?
No. You have to do your math correctly. Please understand that my per ton realization has gone up. The blended realization, I don't know how you are calculating. If you want, we will give you a detailed calculation sheet. Mr. Jaju, CFO of the company, will send you a mail, or you can send him a mail asking precise questions. I think you are mistaken somewhere.
Got it, sir. We were just basically dividing net revenues by...
So that is the point. You have to be slightly careful, my friend. You write a mail to Mr. Jaju, and Mr. Jaju will give you the reply.
So, sir, what would be the comparable Q-on-Q change in pricing for the company?
One second. December 24 realization. He's talking outside. Yeah. December 24, it was 4652. December 25. September 25. And December 24 is 4554. I don't have the September 25 numbers.
Got it. Sir, any color on the capex for next year at this point of time? How much will the company be spending?
As I said, we will be adding about 26 to 30 RMC plants. and the capex expected is about 500 CR
500.
in FY26.
Sure. And so my last question is that it looks on a per ton basis there is a decline in power and fuel costs.
Obviously, there are two reasons. One is that my per kilocalorie cost is lowest in the industry, sitting at 1.56, and my renewable energy has kept on increasing, and it has crossed almost 60. It has reached almost 61%.
Okay. So this trend should continue, right?
This trend, why it should not improve, my friend?
Got
You
it.
see, as far as the per kilocalorie cost is concerned, you have to understand that it is the function of international coal prices or petcoke prices. I cannot take a call there. What I can say is, over the 40-year existence of this company, we have always been the lowest price procurer of fuel, and that is why my fuel cost is lower. My renewable energy portfolio has kept on increasing. We are having the highest renewable portfolio today, and we have reached almost 61%, and we are trying to add 2 or 3% more. As far as Kodla, the new unit which is due to be commissioned by March, I'll be having a waste heat recovery system there, which will add on to my renewable or alternative energy. So the energy cost should logically come down if the coal and petcoke prices do not go up.
Got it. That's very clear. Thank you very much, sir.
Yeah.
Thank you. The next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead. Sir, you may unmute your lines.
Hello.
Hello.
Yes, Rajesh.
Am I audible?
Yes, you are.
Yeah. Hi, sir. Good evening. So just few housekeeping questions. What were the trade, non-trade, trade and blended cement share in this quarter and lead distance?
I will give the line to Mr. Subhash Jaju. He will give you the answer.
The lead distance for the quarter is 446 kilometer, and the trade sale is 65%. What else you want?
Blended cement?
Blended is also 65%.
Okay. And if I look at your fuel cost sequentially, this has come down by around 10 paisa. So there is a 50 rupees per ton saving, and your green power mix remains similar. So, how is the power cost per ton at a company level?
Power
cost per unit.
Power cost.
Average power blended.
Yeah, one second. Means bought out and renewable and waste heat recovery and everything.
Yes.
I may not be having that data immediately. I will send you.
We will get back to you, Rajesh, on this.
Sure, sir. Yeah, certainly. And the realization for the quarter you mentioned was 4625, right? Grey cement.
4652, I think.
Yes.
4652. So which is almost 3%, 4% decline quarter on quarter.
That is what I'm trying to figure out. The earlier somebody had asked a similar question.
No, on a blended basis, because you don't disclose the power revenues, that is why. The blended number.
Ravi Saab, 2 minute मेरी बात सुनो. What I'm saying is that we will, you write a mail to us, we will reconcile the numbers and get back to you.
Understood. And just wanted to understand, you mentioned that you'll be focused more on bridging the gap and getting a better price and realization. So at least on the volume, what sort of growth one should build in for this year? Because earlier you were looking at 37 to 38 million ton for this year, which seems there could be a slip of 1 to 2 million ton on the volumes. So
I already explained what was the rationale.
Right, understood.
Mr. Ravi, please hear me out fully. Number one, the demand in October and November was low, that you know.
Right.
Which I had no control. December, the demand picked up. We have picked up more. January, the trend is similar to December. We don't find any let-up in February and March because the central government budget has to be spent by 31st March. So I don't think there will be any let-up in volumes. I can easily and with a great deal of confidence say that within this quarter we will do 9 to 9.5 million tons. In total, yes, I will not be growing at 7 to 8%. But then that was a function of low demand. What to do?
Right.
But going forward, I am confident that we should do. You see, today the RBI governor has pointed out to a 7.4% GDP growth rate for 26-27 in his MPC. And I had been maintaining that cement generally grows at 1 to 1.1 times national GDP. So next year I expect the demand to be around 7.5 to 8%.
Great, sir. And lastly, if you could share the UAE performance, which you did in last quarter.
It is getting better by the day.
Okay. Possible to share the volume, revenue, and EBITDA numbers?
I will not. I don't have the UAE numbers with me at the moment. We'll share it with you.
Okay. Great, sir. That's all for now. I'll come back in queue. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, sir. Thanks for the opportunity. Couple of questions. First,
I'm sorry, I missed your name. I missed your name.
Indrajit Agarwal from CLSA.
Bolo bhai.
So first, on pricing, can you indicate how the trends have been so far in January and heading into February, both on...
As I said, the December pricing was much better, and the same trend is continuing. We don't see any let-up in demand because of the central government compulsion of completing exhausting the budget within this quarter. So if demand is good, then pricing will remain good. As a matter of fact, as we have been focusing and we have been achieving convergence in or reducing the delta between our price and the Ultratech price, I expect the same trend to maintain, maybe at a slower pace, because I'll be doing volumes now also.
And sir, secondly, do you think that from now on we will continue to grow ahead of industry or largely in line with industry at least?
Let us say, if I want to push volume, then I have to sacrifice price, isn't it? Both don't go hand in hand. So it is a calculated equilibrium game which we have to play, and as the scenario emerges, we'll keep on updating you. As on date, I expect no let-up in demand and no let-up in pricing.
Sure. Thank you. That's all from my side.
Thank you. The next question is from the line of Jashandeep Singh Chadha from Nomura. Please go ahead.
Oh, Chadha Sahab, why are you troubling me?
Thank you so much, sir, for the opportunity. I won't trouble you much, sir. Just a couple of quick questions. Firstly, sir, Shree Cement has been operating in multiple regions. I wanted to understand a basic understanding of how all the regions are performing, not necessarily from Shree perspective, but from industry perspective. And from Shree...
One second. Can we be at divergence with the industry region-wise? So we will be in line with the industry only. Exactly how much Shree has sold in each region of its capacity, the number I am asking Mr. K.K. Jain to share with you. That in this region, say Shree's capacity is 100, then region-wise how much we have sold in this quarter, and that should be roughly the line of operation of all pan-India cement companies. Original companies, it's not comparable. So I am asking Mr. Jain to give you the reply.
Yes, in North region, the sale is 53 lakh ton, 5.3 million, lakh ton, and East 23 and South 11, And in percentage term, it is 61% in north, east 26%, and south 13%.
Thank you so much, sir. This is a very valuable information. But I was also looking from, from January and going ahead, which region you are seeing, uptick coming
January,
in volume demand.
what is the date today, my friend? It is 6th of February. What is the date today?
January onwards. January onwards.
Let the January numbers come to me.
Okay, sir. I'll maybe, once they're out, I'll reach out. Second question was, yes, sir. So second question was on I understand on per kilocalorific value, Shree Cement has been the lowest and will continue to be the lowest. But with petcoke, international prices going on, what kind of impact will be on the cost for fourth quarter? If any sense you can give us.
Please understand that nothing stops me from changing from coal to petcoke or petcoke to coal. I have multi-fuel burners. This is a constant exercise which my purchase people do, that which mix gives them the best landed fuel cost. I am not at all concerned with international prices. I am concerned with landed cost of fuel because that is the actual cost to me. So this is a constant exercise. As on date, we are at 1.56 per kilocalorie. It may remain same for January, but it may go up in February and March. In any case, I don't think it should increase 1.80, which is my peer group fuel cost.
Understood, sir. Understood. And thank you for that. Just one last, more of a clarification. If I can understand from your previous, answer to the previous question, you are expecting 7 to 8% YoY growth from the industry, and Shree Cement will largely be in line with the industry. Is my understanding right, sir?
Your understanding is correct, with a caveat that we have generally grown better than the industry. Last 1 year you leave, because that was with the strategy of narrowing the gap between the selling prices. But once we have achieved that, then probably we may grow better than the industry also. But let the time tell its own story.
Sure, sir. Sure, sir. Thank you so much, and all the best for the future, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Shravan Shah from Dollar Capital. Please go ahead.
Yeah. Thank you, sir. Sir, two questions. First, in the last con call Q2, you highlighted that investors should look at the Shree Cement from the console perspective. But and in last 2 quarters, you have said the UAE volume, and this time this is not part of the press release. And also post the call when we try to connect with the CFO, sir, Mr. Jaju, he is not ready to share the numbers. So how one can look at these things? This is first part. Second,
No, let me stop you here. 1 second.
Yeah.
Do you mean to say that we have not published consolidated numbers?
No, volume. I'm saying the volume.
Wait. No, 1 second. So please go through the results. I don't think you have gone through the results. Please go through the results. Standalone is there, consolidated is there. And you very well know how to calculate UAE from the 2 numbers. So what are we trying to say? You try to make the simple things difficult at all the times whenever we receive your call.
Sorry, sir. When did I make it difficult?
Let us not argue on this. You ask your second question.
Yeah, sir, what's our clarification on the MCA investigation that is on under section 210?
There is no investigation. It is a routine inquiry. They have asked for information. The information has been shared.
Okay.
They have not come up with any report. So what do I do?
Okay, no issues, sir.
Yeah.
Sir, road rail mix for this quarter and fuel mix for this quarter.
Mr. Jaju will give you.
Road rail is 88 and 12.
And fuel mix, petcoke and coal and
It's 76% pet coke, 6% coal, and balance is alternative fuels.
And capex till now, how much we have done, and for
Till now we have done around 1500 crore. And another 400-500 crore is to be done in this quarter.
May we request that you return to the question queue for a follow-up question? The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Just first question on the strategy on pricing versus utilization. You've added capacity in north and south in the past few quarters. How do you look at an ideal utilization given these capacities have been added, but overall volume increase is not there? So, is there an ideal utilization you look at when starting an asset to optimize the operating leverage fixed cost there?
Please appreciate that I had always been maintaining that demand is not in the hand of any cement manufacturer. Demand emanates from overall growth within the economy. We are not happy with our current capacity utilization. We are taking steps to correct it. We have corrected it largely to some extent in January. I have also pointed out that we are concentrating on setting up more and more RMC plants, which should give me a fillip in capacity utilization. But at this point of time, especially in this quarter, because this quarter may be the demand may be abnormally high due to pull from the central agencies, we may better answer this question in the first quarter of 26-27.
Sure. Sir, in that context, the focus on utilization, how do we look at the 80 million ton? Would you rather wait to improve utilization, and what's the progress on Jaisalmer?
Generally, your thinking is correct, that we are not announcing specific sites and specific plants only because we want the capacity utilization to increase. I had hinted that 80 by 29 may get deferred or may culminate is completely dependent on how the demand turns out in 26-27. So this is a question for which I don't have a ready answer. I would like to expand. Please understand that Shree Cement has increased its capacity 110 times from 1985. Means in last 40 years, we have grown 110 times in capacity. So our growth has not been lagging. Our CAGR for growth is 12.5% plus. And we expect to do it better. But then you must set up capacity not for idle capital, but for productive capital, which is a function of demand. If the demand doesn't have the necessary leverage, what is the point in setting up capacity and keep on operating at 56, 60%, 62%? Ideally, we should reach 70% kind of a capacity utilization. Now, whether it takes place in 1 year or in 1.5 years, time can only tell.
Okay, perfect. Thank you so much.
Thank you. The next question is from the line of Siddharth Mehrotra from Kotak Securities. Please go ahead.
Thank you, sir, for the opportunity. Sorry if I missed this number. So what is the capex we are expecting for, say, 2027?
Look, my major focus is going to be 26 RMC plants, 26 or 30. Per RMC plant, it costs 4 to 5 crore. It costs about 5 crore. So 150 crore visibility I have. Balance is completely dependent on how I try to attain. Like March 26, we will be completing Kotla plant. We have spent about 2,000 crore of capex in this financial year. Next financial year, I am giving you 150 crore capex. I am also working on railway sidings, which should be About how many crore per kilometer?
Around 150 crore or 200 crore on railway.
About 200 to 250 crore on railway siding. So 4 to 500 crore of capex visibility is clearly there. Balance visibility I'll be able to give you once I start planning my further capacity addition. So you will have to give me one more quarter to give you more clarity on this. However, you may be fully aware that we are completely debt free and we have about 6,000 crore of free cash sitting in our balance sheet. So we are not worried about the quantum of capex we need to spend. We would like to be watchful of the demand and the potential capacity utilization.
Understood, sir. So essentially that means we are planning to put at least 2 railway sidings, approximately 150 to 200 crore per siding, as well as the RMC plant. 500 crore we have clarity, and maybe some additional capex basis whatever your capacities you sort of decide. Is that correct?
Which I will be able to tell you either in next phone call or in the June phone call. I don't know. You will have to give us time.
Okay. Second, sir, could you sort of quantify what sort of industry growth was prevalent in 3Q for the industry? Some ballpark numbers?
The Q3, you see, it is not comparable. I had a different strategy of operating my plants. The industry had a different strategy. So they are not apple to apple comparison. I was concentrating more on value, less on volume. So obviously my growth was lower than the industry. If you want, we can share those numbers, or those numbers will be available elsewhere also. But you can write a mail either to Mr. Subhash Jaju or to me, and we will give you the reply. We have not grown to our fullest capacity, to our fullest, what should I say, potential by design. Now we will see how it goes.
Got it, sir. So can I just please get the power mix split, sir, if possible? It's 34 megawatt was the total green power mix. There should also be additional captive power. So could you just lay out what are the individual components, say solar, WHRS?
Wait a minute. Mr. Jaju will give you exact power plant capacities of various kinds.
See, our total power capacity is currently 1137 megawatt, out of which 503 is the thermal power capacity, and balance is all green. WHR is 265 megawatt, solar is 314, and wind is 56. So 64 megawatt of green capacity, 503 of thermal, total 1137.
Understood. So just one last question, sir, if I could squeeze in. Sir, a couple of your peers have sort of sounded out that they see a very interesting and exciting opportunity in UAE to either sort of increase their stake in subsidiaries there or expand their capacities there in additional grinding units. So, sir, given the fact that you already have a long-standing exposure to that geography.
Let me stop you here, my dear friend.
Yeah.
Do you think that if there is a profit opportunity, Shree Cement will let it go a begging? If there is potential, if there is real demand per cup, if the operations are profitable or good enough profitable, we'll certainly do whatever is required to be done. We have the largest cement plant in UAE today in our control.
So nothing has changed, at least from our perspective, in terms of the market opportunity.
I don't know. I would not like to comment on that as of yet. I'll comment in March.
Understood, sir. Thanks a lot for your time, sir.
Thank you. The next question is from the line of Tushar Chaudhary from Prabhudas Lilladher P Limited. Please go ahead.
Good evening, sir.
Good evening. First of all, please do me a favor. If you meet Amisha Ben tomorrow, please give my regards to her.
Sure, sir. So just wanted to know, this employee cost is little bit higher this quarter. Is it because of Baloda Bazaar?
No, read note number 3 of the result.
Okay, I missed that then. impact, no. So volume, actually, I wanted to know how much is the...
Listen, the new labor code has made me provide for all back liabilities, which is amounting to 56 crore. We do not show any expense as an exceptional expense because it is all in routine course of business. So we have additionally provided 56 crore as required by the law, and we have disclosed it by way of a note in note number 3. This is on employee cost. Now, what is the second question?
Volume 2% growth is written. Last year it was 8.77.
So last year what had happened, my dear friend? Last year what was my realization? This year what is my realization?
I have the blended realization.
December 24, my realization was 4,554. Is it correct? Yes. And December 25, my realization is 4,652. So you sell to lose money or you sell to make money. We have deliberately constrained our volumes to decrease the delta between other selling price and my selling price.
Understood that.
We have reduced it by 50%. Now we'll see what to do.
Then, no, I understood that, sir. You had explained it pretty well earlier. 2% volume growth is it including clinker?
That I don't remember it often.
Because press release is saying 2% volume growth.
I will get back to you. You send a mail to Jaju, and Jaju will get back to you with the exact numbers.
Sure, sir. Thanks.
Thank you. The next question is from the line of Naveen Sahadio. Please go ahead.
Yeah, good evening, sir. Am I audible?
How can you not be audible?
Thank you, sir.
You are the host.
Thank you, sir. So my question was on this value versus volume strategy in the context of market share as well as industry superior profitability. Like past 4 quarters, as you mentioned in your opening comments, since October 24, the strategy of value over volume was clearly, I think, rewarding us in terms of significantly higher EBITDA per ton or margins versus the peers. In this quarter, it is a bit of a dampener, and also, of course, the volumes are also some maybe, if I may say, some loss of market share as well.
Naveen, slow down. Hear me out. There were 2 major changes in our sales strategy in last 1 year. One was that we had made our rebate and discount policy so transparent and non-negotiable and non-discretionary that the favored dealers were getting pissed off. So it took some time for them to realize that this is a non-negotiable policy, and now they have fallen in line. And number 2 is that in November, we have inducted a new president marketing, and he has shown good results in last 1 month, 1.5 months. So I expect that the things should be better in coming times. Now, of course, I can say anything. I cannot be bullish on cement. So I will keep on talking bullish sentiment on cement. But please understand that demand is not in my hand. If demand is there, you will not find us wanting.
Helpful. Thank you so much. My second question then was on realizations. Again, so I think in Q3 we have sequentially, I think, realization drop is about 4% odd.
Yeah, look, sir, all of you are saying this. Unfortunately, I don't have this number. But आप लोग सब कह रहे हो, तो maybe this is correct. Maybe there was a drop in realization or whatever. But you ask me a pointed question, or you keep on coming to Calcutta. Come one day, I give you good tea. You have nice tea. I will give you good lunch also if you want, and we will discuss this threadbare.
Right, sir. So then I'll have the discussion over tea. Thank you.
It is better. सामने बैठने से we talk more freely and with all the data.
Sure, sir. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
He must be having some other. Yeah, sorry.
Yes,
yeah.
Sorry, I missed one. I just want to clarify one number. Did you say fourth quarter run rate to be similar as December and 9 to 9.5 million tons volume in fourth quarter?
Yes, I did.
So that would imply more or less flattish YOY number. Is that understanding correct?
Maybe 1 or 2% growth. I don't know. I have not done the math.
Sure. Thank you so much.
Chicken.
Thank you. The next question is from the line of Harsh Mittal from MK Global. Please go ahead.
Good evening, Ashita. Thank you for the Sir, just one question. So given that our cash levels as on December ending is 6,000 crores, and we are expecting a healthy cash flows in the coming year with a limited capex. So, sir, can we expect a material upside in the dividend outlay going ahead?
Let us understand, material is a relative definition. So let me assure you that yes, the dividend payout will be better. It is not my prerogative to say how much better, how much not better. That is up to the wisdom of the board. But I expect the dividend payout for 26-27, for 25-26 to be better than 24-25. And it is not a differential of 5 rupees kind of a thing. We may give you a better one.
Thank you, sir.
Thank you. The next question is from the line of Lakshminarayan from Tunga Investments. Please go ahead.
Yeah, thank you, sir. Sir, some of the return metrics for the company, we see that it's currently trending downward, predominantly because of lower profitability from incremental capacity.
No. My bad. Sorry. Please let me correct you. The profitability absolute number has gone down because we had by choice taken a value over volume path. Please understand. We have achieved the convergence in vis-a-vis, say, Ultratech on per bag prices. So it is not that the capacity utilization has substantially affected my profitability. It was my design that it had of lower volumes to better my prices, which had affected the profitability.
Got it. So my question is slightly different. I mean, I understand your point. So now our ROCE or ROEs are trending downwards over a period of time. So given this trend, what is the primary metric the company prefers to evaluate its long-term performance?
One second, my dear friend. Let us understand. If I keep on making profit, my capital employed keeps on going up. If the additional profit I am not distributing or I am not utilizing for capex, then it is giving me a 4 to 5% treasury return. So if you combine everything, you find that the ROCE or the ROE is going down. On the other hand, I am committed to add on capacity to 80 million tons. So what do? I have to bear the pain of rather inefficient cash utilization in the form of treasury till I formalize my plan to have major capex. For the first time in my career, I think I have spoken of a 400 to 500 crore capex visibility in next financial year. We have never done that. But then the demand scenario is such that I cannot give you a firm commitment on when my capacities will come up. As soon as the capacities come up, the 4% return cash, once cash or the return on cash of 4% will translate into 20%, which will automatically jack up the ROCE and ROE. So you will have to bear with me.
Sure. Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1. The next question is from the line of Uttam Srimal from Axis Securities Limited. Please go ahead.
Yeah, sir. Good evening, sir. Thanks for the opportunity. Sir, my question pertains to premium cement. We have made a very good progress from 15% last year to 22%, 10% last year, 22%. So where do we see this number going forward in next year?
Can you have you read any cement research report which has talked of anything else but premium cement? So if everybody is going to make premium cement, then where is the premium here?
Yes, sir.
Then it becomes the premium cement becomes the normal cement. Number one. Number two, the brand belongs to the company. The classification of brand also belongs to the company. There is no standard which defines premium cement. So it is your 10 brands, it is your pen and it is your pencil, and whatever you want to put, you put as a premium brand and sell it, because there is no yardstick to define what a premium cement is. So please understand, we are at about 21-22%. We have defined our premium brands and we are sticking to it. We are not changing the mix of my total cement as per my convenience. And at the moment, with the current demand scenario, we are at 21-22%, and we expect to maintain the same rate for this financial year. Next year, what will happen? Let us see.
And sir, in next year, what would be our depreciation cost?
What will be our?
Depreciation.
Depreciation should be about 1,600 crore.
1,600?
20%.
You said 1,600?
Yes, I said 1,600.
Okay, sir. Thanks a lot. Yeah. That's all from me.
1,600 and 1,700, please don't hold me to the number. But it will not be as high as it had been.
Yes. Okay, sir. That's all from my side. Thanks a lot.
Thank you. A reminder to all participants to press star and 1 to ask a question. The next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hi, sir. Just a follow-up question. On the realization which you explained that you have bridged the gap with UltraTech, and I believe that is visible in numbers when I compare yours with the like-to-like numbers of UltraTech. In last 1 year, while your competitor has shown a 50 rupees decline, your realization has gone up by 100 rupees. And similarly is the trend in for last 2 years. There is a sharp swing upward on your numbers. However, if I look at the margin front, your margins have been, more or less flattish year on year, while the competitor has seen a margin upswing both on a year-on-year basis and a 2-year basis. So is it like you have maintained your pricing?
Ravi, 1 second. Fixed cost recovery is completely dependent on capacity utilization.
Right.
That you appreciate?
Yes.
To catch up on the value terms, I had sacrificed volumes. So my fixed cost recovery was less. So my margins dropped. Now if I play intelligently, my fixed cost recovery will improve and my margins will also improve.
Right.
This is the first time in the history of this company that I have reported a more or less equal EBITDA per ton net of labor code expenses vis-a-vis UltraTech. Otherwise, we had always maintained 100 to 150 rupee delta plus side, and I expect to catch that up.
Great. That's heartening. And so just on the adjusted for the labor cost, still your employee cost is higher by 20 crore quarter on quarter versus
So
250 odd crore.
My dear friend, what happens if I increase my capacity?
Okay. This is with regard to the new plant ramp up.
Exactly.
Okay. So we should factor in this number as a recurring number and accordingly. And so lastly, just on the UAE business, could you make it a practice to in the press release only to share the volumetric and the numbers in AED? Would that be more useful for us?
I will certainly give a thought to this. Give me 1 quarter. Let us see what I can do in next quarter.
Sure.
If I can, I will certainly do that.
And so lastly, could you repeat the capex number for full year and next year? What are you targeting?
This year I'll be doing 2,000 CR.
Okay.
I have already completed 1,500. I'll be doing about 500 CR in this quarter, means January, March.
Okay. And
next year? I have Next year I have not firmed up my plan on further cement capacity addition. We have frozen the plan to set about 30 RMC plants. One RMC plant costs roughly 5 to 6 crore.
Okay.
So you take about 200 crore for RMC, 200 crore for my railway sidings, and 50 to 100 crore normal routine capex mil jata hai. So I am giving a guidance of next year capex at 500 CR.
Okay.
But I am putting a caveat that this is only because I have not formed up my plan of adding up further capacity. If that gets fructified, the number will substantially change. But you will have to wait for that.
So just to confirm, that's clear, sir. That is clear. And so there are no capacities which will come on stream next financial year, at least because no concrete work is going on as per,
Yes, I don't think we will go beyond 72 million ton, which we will achieve by March 26.
Okay. Great, sir. That's all from my end. Thank you.
Thank you. The next question is from the line of Naveen Sahadev from ICICI Securities. Please go ahead.
Yeah, I'll take the last question, sir. So, in the you mentioned that we have narrowed the price gap versus the industry leader from 30 rupees to 15 rupees. So, what is then the next milestone? Is it coming at par, or is it how should one benchmark it that at that point of time onward, then we again start chasing volume?
Naveen, hear me out. I don't have the capacity or capability or even the enthusiasm of saying I will sell at par with Ultratech. If I say that, you will not believe it. But on the other hand, with full confidence I can say that I'll maintain the delta on a EBITDA per ton basis vis-a-vis the competition, which I had been doing except in this quarter. I've been doing it for 40 years, that you know.
Of course.
This quarter, we lost out on volumes, it's all right. It was a calculated move.
Fair point, sir. Sir, on the staff cost, I just wanted to know what would be the normalized cost. I mean, this quarter, of course,
you ask this to Jaju, I don't know.
Okay. Last question to you, sir. Last question. At a broader industry level, do you think non-trade share or non-trade exposure is rising because everybody is chasing those bulk volume, RMC units? Is that a fair thing to observe? Or?
No. I think you are, as I told you, my dear friend, this quarter becomes very typical. Non-trade is basically the large purchases by infrastructure projects. This quarter, the government has to finish the budget allocated in 25-26. So this quarter, you may have a trend where non-trade may be more, but I don't think that is a sustainable trend. We will go back to 75-25 kind of a level. We are today at 65-35.
Understood. Very clear, sir. Thank you. Thank you so much.
Acha, listen.
Yeah.
Is your last question finished?
Yeah, I'm done. There are no more questions.
So why are you always the last one to shaft me?
Over tea, we'll discuss this. So, thank you. Nessia, you can go ahead and conclude the call, please.
All right. On
Thank you and bye-bye.
On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.